demand destruction. Global oil demand could contract this year for only the fourth time in nearly 40 years as the coronavirus stunts growth. Can OPEC Plus come to the rescue? Back to work China indicator. How fast activity picks up is pivotal for the global economy. We have one chart that tells the story. No peak Permian. I speak to Chevron CEO Mike Wirth about his Permian productivity plans and if M&A is in his future. I'm Alix. Welcome to Bloomberg Commodities Edge. 30 minutes focused on the companies, the physical assets, and the trading behind the hottest commodities with these smartest voices in the business. First, we kick it off with Spot On. It's our take on the big story. And the spotlight today is on OPEC. Brent crude holding steady below $52 a barrel. OPEC ministers agree on a sharp production cut. Russia, though, not yet on board. Joining me now from Vienna is Manus Cranny, Bloomberg Daybreak Middle East and Europe anchor. Manus, what's the latest? I know there's an informal meeting right now.
Yes, Alex, there's negotiations and horse trading going on up the road in the Hyatt. That's what the Saudis are. Here behind me in the Kempinski, you've got the Nigerians, the Emiratis, and along with the Iranians. And Zanganeh, the oil minister for Iran, literally just tracked in. We got it in Farsi. It's on my Twitter account. But the essence, not that my Farsi is that fluent, but Gallner was with me, is that the 1.5 million barrels that's in the headline, which is 1 million for OPEC and 500,000 for non-OPEC, this comes down to the Russians getting on board for that kind of size and scale. What we understand is that the Russians have not outright said no. So the headline of 1.5 million, you see a phlegmatic response in the oil market going, yeah, so what? You got to get everybody on board. If you haven't got everybody on board, and even if you have everybody on board, why is WTI not moving more aggressively to the upside? Because this market was in surplus. You run the risk that this is not the size of cut that you need. As every headline that drops, evacuating parts of Canary Wharf in London, evacuating other institutions, taking people on leave. So the escalation and roll-up in the coronavirus story doesn't necessarily give you the feel. I'll just put a number to you, okay? From Christmas when I was here until today, you're now looking at the prospect of 3.6 million barrels coming off the daily production in OPEC+. Alex.
All right, thank you so much, Bloomberg's Manus Cranny. And it's been said that there is no plan B. The problem is, as Manus was saying, no matter what OPEC does, it might not matter. That's according to Jeff Curry of Goldman Sachs, global head of commodities.
I would argue, regardless of the size, it's too little, too late. You look at the forward curve, it's already pricing in that inventory build going forward. So the question is, how do they mitigate the build in inventories as we look out towards the course of the end of this year? So I think the downside risk is still there. We're comfortable with our April target of $45 a barrel on a Brent basis.
Joining me now through Skype is Sarah Emerson, ESAI president. Sarah, what happens if we don't get the 1.5 million barrel a day cut?
I don't think we need it, to be honest with you. I think the estimates of demand destruction have gone a little overboard with the coronavirus, and as it spreads to other countries, there's a learning curve for the healthcare workers. And I think this is one of those situations where it's not going to be as bad in new countries as it has been in China and to a lesser extent Korea. So I think the demand destruction is there, but I don't think we're going to actually go to flat demand or negative demand this year. It'll be a bit of a recovery in the second half of the year. So I don't think OPEC has to get to the 1.5.
What gives you the confidence that it's not going to be that bad?
Well, we've been studying demand for 30 years. And when you look at all the various crises we've had in the past, there almost always is some kind of learning curve in terms of response, whether it's a medical crisis or it's a weather crisis or it's a financial crisis or whatever. There's usually some sort of response. Humans respond and the markets respond. And so when we look at the demand, and we look at demand in every product in every country in the world, and we try to figure out which products are actually going to show decline, there's definitely a big demand destruction going on, but it's not of the kind that I think some of these very, very pessimistic forecasts suggest.
So when you take a look at the product market and tied to the crude market, the rhetoric is that China's still producing a lot of product, dumping it on the market. Refiners are getting their product dumped on the market too. There's not that end demand that's backing its way up in the refinery system and then leading to less crude demand. What part of that story might be different from the way you look at it?
I think the first quarter and the second quarter are very problematic. Absolutely. Demand destruction. The product markets has led to less crude oil demand. But we're talking about not having any resolution of the crisis anywhere if we can extrapolate the current trends of the first quarter, which seems to be what the demand destruction case is. By the third quarter, now you have demand rising seasonally, and we assume there'll be some resolution, not resolution, but there'll be some effort to respond effectively to the outbreak of the virus in other countries. And so that's it. It's just when you look back at other problems we've had like this, eventually humans and markets respond and you begin to fix things. And so I just don't think you can say that this demand destruction goes for the entire year. Certainly, Q1 and Q2 are problematic.
So when it comes to OPEC then, you said they don't really need that 1.5 million barrel a day cut. What do you think that they should be doing then?
Well, the only reason I say that is I do think they should be cutting 1 million barrels a day for OPEC. But the other 500,000 that is unknown at this point, because that requires countries outside of OPEC to cut, notably Russia, I don't think that's as critical as the million. I don't think Russia is going to cut a significant amount. They've sort of gone along with the deal in 2019, but they did sort of almost half-heartedly. I think they absolutely will come out diplomatically and say, yeah, we're on board, we're going to try to help. But the idea that you're going to get another 500,000 out of non-OPEC, I just don't think that's the case. But if OPEC cuts the full million, and then in July they don't go back up, but they go back to first quarter production levels, then actually you're still taking quite a bit of crude off the market. The other unknown, of course, is Libya. Libya is not producing. So is that going to be extended? If that's extended past the next month or two, that also is very helpful on the supply side. At the same time, shale has stopped growing. So there's just a lot of variables on the supply side that are going to help ease the transition here. Bad first and second quarter, but I think third and fourth quarter look a lot better.
So unfair question to you, Sarah. Where do you feel like the bottom's going to be found here in oil?
Well, now you're talking about perception. And now, the financial markets are looking at this and sort of saying this looks really bad. It's going to continue to look bad the rest of this quarter. Certainly will look bad in the second quarter. So, you have a situation where the price could lose another $5 or $10. But at some point, there's going to be a floor. And maybe it's $40 Brent, maybe it's 45 Brent. Right now, Brent has had a hard time breaking below 50. And so, I think at some point in the second quarter, I think we're going to start seeing news stories saying, okay, crisis is spreading, but the health professionals are beginning to find ways to manage this. And the other thing, too, is the people of Wuhan were taken entirely by surprise. Yeah. Now everybody all over the world is thinking about, okay, I have to think about maybe I won't go on a plane, et cetera, et cetera. So and maybe they're thinking I will actually self-quarantine as well if I get a cold.
Sarah, thanks so much. I really, really appreciate your time today. Sarah Emerson, ESAI President, thank you so very much. And staying on oil, you got Exxon tapping the brakes on its flagship shale project in the Permian Basin. At its Analyst Day in New York, the company cut Permian production growth by 10% for the next 2 years and said CapEx will come in at the low end of the range. Now, the move sent the stock to a decade low. The oil price didn't help either. All of this also a sign the oil majors are holding back on production in response to the latest price slump. And investors, though, still clamoring for free cash flow that Exxon can't deliver. Exxon still plans to almost triple output from the Permian Basin by 2024. This is Bloomberg. I'm Alix Steele. This is Bloomberg Commodities Edge. Time now for the Data Dig, where we delve deep into the market trends. First up, the oil inventory numbers. So you have overall stocks rising by about 784,000 barrels, much less than estimated. You also, though, had strong builds in Pad 3, which was interesting because the export arb was wide open, with exports blowing past 4 million barrels of oil a day. So finding out just how quickly China's getting back to work is really key. And here is one way to look at it. It's steel mill inventories. This is the start of the Chinese New Year and the days after that. We're currently at about 22 million tons. That's up 50% from last year. So still a ways to go. And timber, the lumber market, taking a hit from the coronavirus. The number of outstanding contracts right now has lost about 25% in just this past 6 sessions, dropping from a peak it reached in late February. All right, now we want to get into the ring. You got metals versus the coronavirus, and what everyone can agree on is you want to buy gold. So Bank of America, the latest, saying that falling 10-year yields have pushed the gold higher of late, and the 50 basis point rate cut by the Fed, with more likely to come, will in all likelihood extend the rally. A more dovish Fed should limit dollar gains. Hence, we have raised our fourth quarter forecast to $1,700 an ounce. Joining me now from Tampa, Florida, is Everett Millman, a precious metals specialist at Gainesville Coins, a full-service precious metals dealer and one of the world's most active. Good to check in with you. What has demand been like?
Well, I would say on the retail side, demand has actually been fairly weak for gold. More so than people buying, we've seen a lot of retail buyers actually selling their gold. And that coincides kind of perfectly with what gold should do in a crisis or a black swan situation like this. Even when we saw last week, the gold price came down about $80. Most of the time when we see a sell-off in gold, it's because there's a risk-on scenario and all of that money flows into the equity market. We didn't see that this time, so it shows me that that is actually a liquidation event where investors are getting free cash flow and trying to prepare for a situation where the markets are very volatile and there's not really a safe place to put your money besides gold and the 10-year Treasury.
It's interesting that you bring that up because that was a highlight from last week. And what led to that, too, is a lot of gold volatility. You don't usually think of something like gold volatility. Is that scaring off anybody, or is that just the normal ebb and flow of using it to fund your assets?
I think it's a bit of both. Certainly, that liquidation is going to result in people trying to make up for losses elsewhere in their portfolio. But you're right, volatility is usually not what we associate with gold. I think that that is the overarching effect of the coronavirus, is that more so than anything else, this uncertainty has led to greater volatility. We saw the biggest one-week move in the VIX ever on record in terms of percentage, and in absolute change, it was the biggest move for the VIX since I believe about 2008. So we're getting into financial crisis kind of scenarios here, and I think that gold will see some more volatility going forward, but it has much more upside than most other markets right now.
So we hear a lot of calls, 1,700, 1,800. Now we're getting like maybe we could see 2,000 from some of the big banks. What do you think?
Well, my target after the coronavirus hit was about 1,750. I think that that is a reasonable high end for gold right now. It all depends on how long this situation takes to get under control. A historical analog that we can look at is the Spanish flu right after World War I. Now, although you would expect that our infrastructure and response function would be a little better now, a century later, the lesson that we can take from that is that the Spanish flu did seem to abate and dip during the summer, and then there was a sudden outbreak of new cases later in the year. So I think that that is definitely a possibility on the table, that we could see coronavirus continue to spread into the second half of the year, and that's really going to shave a lot off of current projections for GDP. It's going to continue to disrupt supply chains, so all of that is bearish for basically everything except for gold.
Fair. So let's get to that GDP. If you look at GDP as seen through global PMI versus copper prices, there's still maybe more downside to copper if they're going to track each other. Do you expect that to happen?
I do in the short term. I think that copper, silver, the other industrial metals will continue to trend lower. But what's interesting is that so far we've really only seen the demand destruction with those heavy commodities. Further down the road, we could see some supply disruption where once the coronavirus breaks, once we have some containment, that demand for copper and other metals that has been deferred could come right back to the market very easily. So that does kind of give them more of a bullish tint than other commodities like the energies.
All right, good analysis. Thanks a lot. Everett Millman from Gainesville Coins, a precious metal specialist. So the U.S. Senate voted this week to proceed with a 555-page energy bill to speed up spending on energy initiatives that could benefit oil companies that have carbon capture programs. At the same time, regulation for the industry could only get tougher. If you take a look at this, the candidates left in the Democratic nominee race, Joe Biden's looking at limits on fracking, and as we know, Bernie Sanders wants to end fracking. He's also looking at ending all kind of tax incentives. Now, one of the issues that we're trying to address here by the regulation is flaring. So if you burn off gas you can't handle, that increased by about 30% last year, and that's enough gas to supply 5 million homes. That's a big complaint. Now, all of that could actually change now because the head of the Texas Railroad Commission, which regulates flaring, Ryan Sitton, lost the Republican primary on Tuesday. His 6-year term ends in January. The takeaway? It's really, really hard to be a U.S. E&P right now. Coming up, Mike Wirth, Chevron's CEO, we'll discuss with him next on Bloomberg Commodities Edge. I'm Alix Steele. This is Bloomberg Commodities Edge. Time now for Commodity in Chief. We focus on one leader in the commodity world, and today it's Mike Wirth, CEO of Chevron. And I started by asking him just how much more productivity he expects to get out of the Permian.
It's hard to quantify that, Alex, because every year we continue to find improvements in performance and efficiency. And just today we shared with shareholders that our average feet drilled per rig will increase 50% from 2018 to 2020. So we're getting a 50% improvement in productivity out of drilling rigs, which are a pretty well-established technology and something we've been doing for a long time. So costs continue to come down, productivity continues to go up, and every time we think we're reaching a point where we've about found the last idea, there's a new set of these things. So I think there's still some running room to get even better in the Permian.
Are you seeing the same kind of operational issues that some of the smaller and medium-sized guys have, where you parent-child relationships, you kind of frack different areas you don't mean to? Are you having the same kind of issues?
No, we're not, because there was a time when I think some would criticize us that we were going more slowly than some of the smaller companies. We were learning a lot because we have partnerships with several companies who are trying things and learning through trial and error. We were lining up a plan to build a machine, our development plan, that is returns focused, that's highly efficient, and so we never downspaced wells, for instance. We understand which benches are in communication with one another, and we develop those simultaneously, so we develop them as a unit, as opposed to coming back and having some of these parent-child problems. And so issues that you've seen widely reported with some other companies, we've largely avoided.
Your break-even's already really low. It's at 49, right? How much more can you realistically think you can lower that?
Well, we're going to try to continue to lower it. It's a commodity business, and in a commodity business, costs always matter. Capital discipline always matters. Today, we announced the intent to remove another $1 billion in operating cost from our business by the end of this year, and to find another $1 billion in margin capture across our value chains around the world by the end of 2022. This is without any help from commodity prices or markets. It's all through self-help. So we need to continue to look for ways to use technologies and find ways to be both more efficient and effective across all of our business.
Do you want to like 45, 40, or you don't care as long as it keeps going down?
You need to keep it down, and it's hard to know where the bottom is. But look, in commodity markets, one of the things that you never regret is having a low break-even and a low-cost structure.
What gives you the confidence that Chevron can generate cash returns in the Permian when the other guys couldn't?
Well, we're going to be cash positive this year. So we've been investing several $1 billion a year, $3.5 to $4 billion a year. Production has been growing. We outlined the intent to be at 600,000 barrels a day by the end of this year, 1 million barrels a day by the end of 2024, and we break into positive free cash flow this year, and outlined a profile that shows we could produce over 1 million barrels a day, generate over $4 billion a year in free cash flow after investment out through 2040 and even beyond that. So it's reaching the scale and the productivity now that will spin off considerable free cash flow.
Well, I was going to say, is that the scale because you have more good wells that you can develop, or you can develop them more quickly, or did you just do it better and so your decline rate is less, or you just have the balance sheet to be able to keep deploying capital? Like, what makes you be able to deliver those returns?
It's really we've reached the scale now that with the level of capital inputs that we have, which call it in round numbers $4 billion, the operating cash flow exceeds $4 billion, and flat prices will move towards $8 billion, which is where we spin off the additional for many, many years to come.
Gotcha. This is also going to be a really bad and hard time for small and medium-sized companies, for the oil price and for demand, et cetera. What are you going to buy?
I know you have to ask,
I do.
and
But typically you like to invest in bottom of cycles, right? I mean, what kind of qualifications, or nothing at all?
Well, that's certainly a possibility. We've got the balance sheet to consider a lot of things during this part of the cycle. That's a nice thing to have, is the financial capacity and flexibility to consider things. But we have such a strong base program, and we've outlined for the next decade a very compelling case for our shareholders. If we were to do something, we need to convince ourselves and then convince our shareholders that something is better than the hand that we hold right now. And so it's a pretty high bar. Fair.
There is a narrative that all the good stuff's been drilled. Do you see that in terms of your competitors?
No. No, the Permian Basin is an enormous area. We just increased our estimate of resource within just our own portfolio. We only hold about 10% of the land in the Permian. 3 years ago, we saw 9 billion barrels of resource. Today, we updated it to 21 billion barrels of resource.
Wow, that's a jump.
So there's a lot of good acreage to be drilled. And the other thing that we continue to see are improvements in the application of development. So I talked about drilling efficiency. And we're working on technologies to improve recovery. And so I think there's a lot of technology progress still to be made. So there's a long, bright future ahead for the Permian Basin.
So U.S. shale's not peaking?
U.S. shale will continue to grow well into the future.
That was my interview with Mike Wirth, Chevron's CEO. That wraps it up me here for Bloomberg Commodities Edge. Catch me every Thursday, 1 p.m. in New York time, 6 p.m. in London. This is Bloomberg.